So today's cardinal lesson is something that really makes me happy. I mean, we've been uh, working with this group of people trying to come up with a solution. And so the title is You Can't Get Long-Term Care Insurance Because of Your Health. There's a whole group of people out there that they'll even tell us that when they call in or we're talking to them doing, oh, I can't get long-term care because I have this. I can't get long-term care. And so not so fast here. What we're talking about in today's video is right here are 10 conditions that people have in case studies that we're going to show you that have been successful in getting the highest benefit of this long-term care insurance. I want to go through them. Rheumatoid arthritis, chronic liver disease, chronic kidney disease, cancer, heart disease, multiple sclerosis, Parkinson's, fibromyalgia, long COVID, type 1 diabetes. And this is just as far as we've gotten. I'm sure a year from now, there will be another 10 that are unique conditions that people have been successful in getting this highest benefit. And so what I want to just go over is how in the world are we doing this? Because these are just declines. When we do field underwriting on long-term care insurance, by field underwriting is we're in the field, we're talking to people. And when people have had these in the past, we've just been able to say, I'm sorry, or some of them we thought maybe we could get them in because it was the early part of the disease and then they were turned down. So we've got a whole list of no conditions that we're now able to do something for. So that's what has me excited. Yeah, I'm talking about with traditional long-term care insurance, this would probably be a no. And with the hybrid life long-term care insurance, these would probably still be a no. And this is a hybrid long-term care annuity. So a little bit different than life insurance. And so what I want to do is I want to throw it to Tom, and I want Tom to talk about why we're doing this video today.
Yeah, I mean, we're doing this video because one of the hardest things that we have to do when we're helping people plan for long-term care is either tell them you're not going to qualify, or maybe we thought they might, and we put in an application and then they get turned down, and we have to deliver that bad news. I mean, it's just awful. And so what's nice about this is now we have a solution for people who historically have really had no options. They really haven't had a lot of sort of true long-term care policies available to them. And so this is just wonderful for those people. Now, this isn't for everybody, right? There are other policies, if you're healthy enough, that still might be better than this. But for someone who's serious about planning for long-term care and has a health condition, this is just great. And so let me bring up the show notes. They're at the link below our video. They're also on our website on the show notes section. Pretty short today. We just have the board here, so you can print it out if you want and look at it a little bit bigger if you need to. But again, we'll spend the time in the video going through the board, but these are the show notes here. So we'll bring it back up. And Hans, I'll ask you, how can this company do this? Like, how is it that they are able to take these people when other companies won't?
Well, I asked the same thing. If you'll recall, you and I sitting down looking at this just doesn't, they didn't name these conditions, but I could read through this thing and it just looks like people with these conditions are going to be able to get long-term care insurance. How does that work? And so I went into this very skeptical. But as they have a different theory about underwriting. And what has frustrated me all along is that I would be sitting with a couple and they just got back from the gym or they just got back from playing tennis. They work out, they're in shape. But then when we start applying for long-term care insurance, and then we go through the medical history, we'd find out some medical history that you couldn't observe. But when we put that down on the application, the insurance company is just going to say no. And what I've done a lot of reading about is looking at, okay, so these people that have a heart condition or they have diabetes, does this turn into a long-term care claim just about all the time, like the insurance company is saying? And the answer to that is no. So where do the long-term care claims come from? Most of them are cognitive. I mean, when you go to an assisted living or a memory care or, you look at home health care claims, and we look at a lot of them with clients that are claiming on this stuff. It's the memory issues that is a large percentage of the claims. So that's what they need to be testing for, number one. And some of these traditional long-term care companies and the hybrid lifelong, they do a memory test too. So they're onto this, but this company does this on a video, and they're looking at you and they're asking the questions, and they're doing this delayed recall memory test. And it's pretty scientifically, it's going to pull out the people that have early dementia. So you're going to go through that. And then more importantly, you're going to go through this physical assessment. And the physical assessment, it's on a video, and it involves doing some basic exercises. And it's not like you have to do jumping jacks or something, or you're trying out for the Olympics, but they need to see you get in and out of a chair without holding onto the walls. They need to see you walk, turn around, and that you have basic muscle strength and you have balance. And I'm talking about basic. So these two things, cognitive and then where people lack balance and muscle strength, are good predictors of future claims for long-term care. And so if you can pass the test for both of these, all of these people have gotten the highest benefits under this policy. So I'd like to push it back to Tom, and I'd like Tom to talk about the no assessment benefits, the better benefits, and then the best benefits.
Yes, I mean, if you look on the board, we really have three sort of categories laid out. And what another unique thing about this policy is everyone will get approved at some level. Right now, they might not be the benefits you want, but like Hans was saying, all the conditions we've listed over on the right side, they got this best benefits box here. They got the preferred rate. They've essentially taken the 100,000. We've illustrated 100,000 in all three of these scenarios, and they've immediately turned into 315,000. Maybe not quite immediately. We'll get to that in a second, but they've turned it into 315,000 available for long-term care, which is just great. Now, if you maybe can do some of the things, maybe you have a little bit of trouble standing up or need some help getting out of the chair. I don't exactly know the rules. They don't tell us all of sort of the what classifies you in the preferred versus the not, but you can fall into this better benefits column. So you don't get quite the same 315 off the 100,000 you put in, but you get 215. You almost get over double what you put in, which is still really, really good. And so that's also a nice thing where you might not be able to get that best one, but you still have a really good option there. And then the final category, we haven't had any applicant get this rate yet. It's whether you don't want to do any assessment. You say, hey, I just don't want to go through any of this. Just give me what I'm going to get without having to answer any health questions. Or maybe you are not able to do some of this stuff. You have some cognitive issue, you have some balance issues. There is an option to have no assessment. You get 140 based off the 100 you put in, so not a huge growth there, but still it's nice. There's benefits there. There's still reason to look at it. We'll get to that a little bit later in the video. But everyone's going to fall into one of these three categories. When we're looking at this, we're really trying to go for that best benefits box, because again, that's just the best benefits. That's how you get the most out of it. But even if you aren't able to get that, there are still options here. So Hans, why don't you talk a little bit about how the policy kind of works sort of behind the scenes. And I will say, if you guys are interested, if you watch this video and you want more, you want us to run an actual illustration for you specifically, just reach out. We can send it to you pretty quickly, give you a little more details of the inner workings of the policy. We don't want to spend the whole video today going over all the details down to that level. But if you're interested, reach out and we'll be able to help you out.
Yeah, we're just trying to give you a general idea. And the moral of the story is that people with health conditions, and they can pass a simple agility test and a memory test, this can, get them long-term care insurance, which makes sense tax-wise. And then it turns all around, especially with this condition. These people are thrilled that they've been able to achieve this. So most of the time we're talking about this best benefits category. And so we're putting, in this example, we're putting 100,000 in, and it's creating a $315,000 benefit base. And that benefit base is going to get larger over time. But right off the bat, you're getting an additional $215,000 worth of long-term care insurance that is in addition to the 100,000 that you put in. This benefit base is going to grow. I'm going to talk about how that works in a second. But if you divide that by 60, you come up with 5,250 a month for 60 months. And that's the benefit right out of the box. And then based upon the underwriting, you could end up here, you could end up there, or actually, if you want to go for this last, somebody that just says, I'm not going to pass this test, but I still want the insurance, I want the benefits of the extra coverage, well, then they can just skip this and take no assessment, and we can just write them this policy that's way over to the left. Okay, so when I talked about this benefit growing, let's talk about how that kind of works. Is I have the benefit base circled under these three things, and I have it circled up here. So your 315,000 is going to be increased 2% each year for 20 years. So, and whether that's simple interest or compound interest, I haven't gone in that dip. It's just coming to my mind right now. But you can see that after 20 years, that's 40% if it was just simple interest. If it was compound interest, it'd be more than that. This is going to be increased. Now, as soon as you file a claim and as soon as you go on claim, then you stop getting this extra 2%. Now, the benefit base is going to be increased each year with the cash value increase, because this is an annuity. This 100,000 that you stuck in there is going to get an interest credit every year. And we don't know, we know what the minimum is, but we don't know what that's going to be. But whatever interest you get credited every year is going to, the amount of interest that credited or net interest is going to be added to the $315,000. And then the benefit base is going to be increased each 2 years with these wellness credits. So this company is the same company that does the underwriting. They have a wellness credit program where they're going to do an assessment. You call in and you do this, and you do it, fill out some stuff over the internet, and then you're going to do certain things like maybe changing your diet to start exercising, and then you're going to log that in that you did it regularly through an app. And then after 2 years, they're going to give you, every 2 years, they're going to give you wellness credits based upon you completing that plan that you laid out together. So it's kind of cool. So there's 3 ways this can increase, and it will increase, that making it inflation. Another way to make it increase is put in more than $100,000. You could put in, like this client with the chronic liver disease put in 200,000, and the 200,000 got her double of all this, and she's very thrilled to be, because that chronic liver disease is in its early stages. They have new medicines for that stuff, and it's working very well with her, but it's still a big concern long term, and she's just a no-no on any long-term care or life insurance, except for this. That's already in place. Now, there is a vesting benefit. So if you use this coverage right after you buy it, you're going to get hit with, so you only get, in the first year, you only get 20% of your benefits if you start a claim. Second year, 40%. Third year, 60%. Fourth year, 80%. So you need to factor that in. And when you're asking, how does this company do this? Well, they're a bit protected from paying out the full benefit of a claim if one starts immediately. So you need to think about that when you're buying it. And I really want to turn it over to Tom to go over the rest of the features of the policy.
Yeah, I mean, so what Hans was just talking about is how that benefit balance grows. I think it's important to understand that that's not your cash value. That's the number, that's the amount that's available to pay for long-term care. But there is still an account balance left in this policy. And you'll see on one of these points here we'll get to, is that does go to your beneficiaries if there's money still left in the policy when you pass. But let's talk a little bit about these monthly long-term care benefits. I mean, you're buying this policy to get the long-term care coverage. That's really the whole reason we're looking at this. The monthly benefit, and again, in that better, or the best column, the best column is it's without any of the growth in the benefit base. That's $5,250 a month for 60 months. It pays out for 5 total years. That monthly amount comes as an indemnity benefit. So if you've watched some of our other long-term care videos, indemnity benefits are compared to reimbursement. With an indemnity benefit is they send you that cash regardless of the cost of care. So in this example, let's say you need care, you hire a home health care agency, they're coming in and they're only charging $4,000 a month. It doesn't cost the full $5,000. They're only charging $4,000. What this company does is they'll pay you that full benefit it's available to you, the full $5,000 a month, $5,250 a month. They send it to you regardless of the cost. You don't have to show them receipts. The other nice thing about the indemnity benefits is it gives you more flexibility on how you spend those dollars. You could hire an untrained caregiver, right? You don't have to hire a home health care agency. You could hire a family member, a neighbor, a friend, someone like that, reimburse them for their time to help take care of you. I do think that if you're really sick, you probably need to hire someone who's trained to give this type of care, but it gives you just more flexibility. It gives you more options on how to spend that money because you don't have to send in those receipts. It doesn't need to be a licensed caregiver. Just gives you some more flexibility. So it's their indemnity benefits. The monthly benefits are also tax-free. So we've put the $100,000 in. Let's say over the years it's grown to 150. And again, that's not guaranteed, but with good growth, it could get there. It's grown to 150. That $50,000, you haven't had to pay taxes on it because it's inside an annuity. If that money comes out to pay for long-term care, those benefits are never taxed. It's all tax-free, which is a really sort of a sweet deal from this. With it being a true long-term care policy, those benefits coming are tax-free. Where this can also be helpful is if you have, say you have purchased an annuity in the past, a non-qualified annuity, you purchased it in the past, you have a lot of gains in there, you really don't need it, and you're like, what do I do with this? I don't want to pay taxes on it. You could take that money, that account, do what's called a 1035 exchange where you move it into this policy. You don't pay any taxes on that transfer. And then if you need long-term care, those benefits come out tax-free. So if you have money off to the side that's inside of an annuity that you want to transition into this policy, you can absolutely do that. That does bring up an important part. We don't have it on the board, but this policy needs to be purchased with non-qualified money. You say, well, what does that even mean? It cannot be IRAs. It cannot be 401ks. It needs to be money that's already been taxed. It cannot be retirement money to do that. So that's one of the limitations of this policy. But again, this is a really sweet deal. The cash value of the policy, it's not gone. You put the $100,000 in, you never need care. That money plus what it's grown to is going to go to your beneficiaries. They might owe some taxes on the growth there if there is growth there. Or if you've used some of it for long-term care, there's still an amount left, they'd get that benefit too. So it's not gone out of your estate. It's still there, and you get a lot of leverage from the insurance company to provide a really nice long-term care benefit. So again, I don't want to get too far into the weeds. If you're interested, call us. We'll run you an illustration. But Hans, why don't you sort of finish up here, and we'll talk a little bit. This isn't available in every state. So why don't you list off the states that we don't have this available?
So it's Connecticut, California, Indiana, Maryland, Massachusetts, New York, and Virginia. All the other 43 states in DC, you can get this policy. We have other options for you in some of those states, so don't let that be a stop sign. But this, and some of these states may be coming online. This product is about a year old, year and a half old. So sometimes some states object to some things and then they come on later. But for now, those 7 are not available. And I did want to point out is that, we're just talking about benefits and all that. And it becomes real with people. I mean, this guy, this case study, 78 years old, rheumatoid arthritis. And he already had long-term care insurance, but he just didn't think it was enough. And so he was just thrilled to get this and get the benefits. And then he realizes that he's not anywhere near a claim. He walks 20 miles a week. So this policy is available through age 80, and that means 80 in 364 days or whatever. So that's the maximum age that they'll write it. And we do have plenty of people in their 70s buying this thing. So these are the states where it's not available. I want to close and just talking about how this fits in comprehensive financial planning. I can't tell you how many people that we are doing a financial plan for. They're both in their mid 60s, late 60s. Um, and part of the overall financial plan is one of these hybrid life long-term care plans, perhaps even bought with IRA money. And then we send in the application, and then one of them gets turned down. And then, you know, the one that gets turned down, well, the next thing we need to do is we need to convince the one that got it to take it, which is kind of hard to do when their spouse just got turned down. And then this product comes in since we've had it, and many times can take care of the spouse that got turned down, and it just makes the whole financial plan work. This becomes a big stop sign when the long-term care part of the plan just gets held up. So we've gone over, touched on long-term care. That's what the whole video is about. We talked about taxes, because I can't say this enough, that the benefits coming out of this policy paid for long-term care, and that can be at-home care as well, are tax-free. So this $5,250 a month, or 20 years from now, it's going to be $7,000 a month, or more. That's all tax-free. So want to make note of that. And then as far as estate planning, is you put this money in here. A lot of older folks have money saved and they're not touching, and that money is there in case they need long-term care. And if they end up passing away and not needing long-term care, then that money in the long-term care fund is going to go to their kids. And this works the same way. As if you end up not needing long-term care, this annuity is going to grow, and then the cash value of it is going to pass to your beneficiaries. So, and as far as income, this is going to be creating a monthly income to you at a time when you really need it. So I want to bring Tom back on. I want to tell you, I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.